Did you hear what Warren Buffett said at the 2025 Berkshire meeting? But did you truly understand what he meant? Every year, thousands of investors follow this event in search of wisdom, but most get stuck on sound bites, quarterly numbers, or the memes that circulate afterward. What almost no one does, and this is what separates the average investor from the intentional one, is read between the lines. In this video, you'll discover the 7 most important lessons from the 2025 Berkshire meeting that went unnoticed by most, but can help you adjust your portfolio with more clarity, more purpose, and much better results. And the best part? In a practical way, adapted to the world we're living in right now. Before we jump into the lessons, let's quickly understand the context of the meeting. This was Berkshire's first major event without Charlie Munger by Buffett's side. The absence was felt not only by the empty chair, but also in Buffett's more restrained and reflective tone throughout his remarks. With interest rates still high, volatility in the tech sector, and a market trying to guess the Fed's next move, Buffett stuck to his classic stance. He spoke little, was direct, and left a lot unsaid. Those who paid attention between the lines walked away with a far more powerful vision than those simply looking for the next hot stock. The first lesson is about patience. Buffett made it clear that many investment opportunities only appear when everyone else is impatient. In his words, doing nothing is also a decision. In today's world, where every headline becomes a buy or sell trigger, patience has become a competitive advantage. So how do you apply that? If you have cash sitting and feel like you're wasting time by not investing right away, think of cash as a strategic asset. Wait for the right price. When great companies fall due to temporary issues, that's your moment to act. Investing isn't about constantly doing something. It's about knowing when to wait and acting with conviction at the right time. The second lesson is about cash. Many people see Berkshire's liquidity, over $150 billion, as a sign of caution. But in practice, it's a sign of strategy. Buffett isn't looking to win in the short term. He wants to be ready when the market hands him a disproportionate opportunity. For the average investor, this means keeping a portion of your capital available, not fully allocated. Even if you have $5,000 or $10,000 invested, keeping 10% or 20% aside to take advantage of dips is smart, not fearful. That reserve can be in a high liquidity fixed income fund, a money market account, or even in stable coins if you're already in crypto. The key is to have ammunition ready when the market panics, because that's where the best buying happens. In the third lesson, Buffett was subtle but firm. He avoided talking about trendy sectors like artificial intelligence and crypto. When pressed, he answered gracefully, saying he prefers not to invest in what he doesn't deeply understand. This philosophy, repeated for decades, is more relevant than ever. Today, everyone wants to ride the next wave. But you need to ask yourself, do I understand this business, or am I just following the crowd? The practical application here is simple. If you don't know what a company does, how it makes money, or how it stays afloat, maybe you shouldn't invest in it yet. Focus on companies you understand. Even if they seem boring, those are the ones that will keep you invested with confidence when the market shakes. The fourth lesson is one of Buffett's most repeated, yet still ignored by many. What matters is the business, not the stock price. During the meeting, he made a point of reinforcing that a good company remains good even when the stock drops, and a bad company remains bad even if the stock goes up for a while. For investors trying to make more rational decisions, this is fundamental. Don't just look at the chart, look at the results. Use metrics like return on equity, ROE, net margin, and earnings consistency. Free sites like Simply Wall Saint, Yahoo Finance, or TKR already provide this info. Focusing on a company's true value is what separates a speculator from an investor. In the fifth lesson, Buffett, with his usual wit, took a jab at over-engineered financial products. Fancy funds, leveraged derivatives, promises of above-average returns. He was direct. Invest in what's simple. And that's a truth few people follow. You don't need 20 assets in your portfolio or to check the market all day long. A portfolio with 5 or 6 solid stocks that you understand and trust can be more stable and profitable. The secret lies in simplicity with consistency. An example, stocks like Apple, Coca-Cola, Visa, or Johnson & Johnson, solid businesses that even beginners can start. You don't need the most complex portfolio. You need the one that makes sense for your knowledge and discipline. The 6th lesson was more subjective, but maybe the most important. Buffett emphasized that an investor's behavior matters more than technical knowledge. In other words, knowing fundamental analysis or reading every report won't help if you don't have emotional control. What makes you lose money isn't the stock you pick, it's impatience, fear, or greed. The practical step: create your own rules before buying any asset. Define a maximum allocation per stock. Know when you plan to sell and understand why you're buying it in the first place. Creating this personal investment playbook is what protects you when the market is either panicking or euphoric. And finally, the 7th lesson. Think in decades, not in weeks. Once again, Buffett highlighted companies that Berkshire has held for 10, 20, even 30 years. And it's not because he forgot about them, it's because they're still good. This mindset shields the investor from noise. While many people sell at the first drop, Buffett buys more. While the market chases the trend of the moment, he accumulates stocks that pay dividends for decades. The application here is clear. Choose stocks with long-term vision. Look at earnings history, consistency in dividends, predictable growth. Invest as if you were the business owner, because in fact you are. Now that you've seen the 7 lessons, let's recap them in a practical checklist. Be patient. Treat cash as strategy. Don't invest in what you don't understand. Focus on the business, not the price. Keep it simple. Master your behavior. Think in decades. Each of these lessons can be applied today, even if you're investing with limited capital. Buffett didn't come up with this yesterday. He's been repeating it for decades. The difference is that few listen and even fewer apply, but you can start now. If this video helped you see the market more clearly, hit the like button, subscribe to the channel, and comment below. Which of these lessons do you already follow? And which one are you going to start applying today? Here, we talk about investing with substance, no hype, and a focus on what actually works for the long term. See you in the next video.